In the last vlog on the 5 steps to financial success, we covered cash flow and budgeting. Now the interest rates have finally started to fall, it's time to focus on repaying bad, inefficient debt and starting to put a plan together to repay your mortgage. Debt can be both good and bad, and how we determine this is by considering whether the money's been borrowed to buy an asset or a material good. And if it is an asset, is that asset income producing or 100% capital growth strategy? The next consideration is the cost of debt. The cost of debt is basically the interest payable. Loans that are higher risk for the lender will have a higher rate. And risks can be based on the borrower's debt levels or income, or if the loan is asset backed or not. The plan we've all heard over the years is to eliminate bad debt, but how do we really do this? Well, we can start with developing a budget to see if we can find some additional repayment dollars that can be used to reduce debt. We can also look to consolidate to a lower rate a loan facility and also develop a repayment plan. Only when the loan is repaid can we start to grow your wealth. Let's now look at good debt. What are good debts? Good debt would include your mortgage as it's backed by your home, or an investment loan that's invested in an income producing property or shares. These loans are backed by assets that grow in value, and the investment loan interest is therefore tax deductible in most cases. But beware, we don't want to borrow $1 to save 50 cents. It must be a good asset. Let's consider a mortgage. What's the best way to manage a mortgage? The mortgage is a good debt as it's asset backed, and the value of the home will rise over the medium to the long term. However, interest is non-tax deductible as the home is not income producing. You're living in it. So it's not a tax efficient structure. So we want to pay down our mortgage as soon as possible. An investment loan, on the other hand, is also a good debt as it's asset backed, but as the asset is income producing, the interest can be tax deductible. It's best not to pay off this type of debt until we're selling the asset, as it allows you to leverage into other assets using the capital repayment to pay interest on other loans against other assets. But remember, this is subject to cash flow and serviceability. Now, as interest rates have increased over the recent years, costs of debt have risen, and this is leading to higher repayments. This is the cash flow risk of accumulating debt. Higher interest rates will equal larger tax deductions on investment debt. However, this is not the case for a mortgage. The key is only to take on debt that you can afford at these higher rates, because it can be disastrous to sell an asset in a high interest rate environment due to an affordability issue. How can Manly Financial Services help you? We can help if you're having problems with your budget, repaying short-term, bad, high interest rate debt. We can help if you'd like to buy a home or investment property and would like help on structuring your asset effectively for tax and investment purposes. And we can also help if you'd like a plan to eliminate your mortgage and grow your wealth over the medium to long term. We've developed an ebook on the 5 steps to financial success that you can easily access via the link in the description below. I urge you to click on the link in the description to access this free ebook via our website that you can easily download. Please subscribe to our channel as it's free, easy, and really helps us get our message out there. Please also click on the notifications bell and like our video if you found the information informative. If you'd like some more information on how we can help you manage your wealth as you grow for the future, prepare for retirement, or enter your retirement years, then please visit our website at manlyfs.com.au. Take care.